Hello, everyone. Andy Tanner here. Welcome to this third Quick Start Lab. I'm here and I'm joined by Corey Halliday. How are you, Corey?
I'm doing so good. Excited to be here.
I'll tell you, I'm so proud of every one of the students, and we thank you for your letters and we thank you for your well wishes and your feedback. The first order of business is during this time, go to webinar. We haven't had too many problems with it, but I've heard that other people have simply because the need for online meetings around the world today has increased so much that sometimes the platform's a little rough. So first thing I'm going to ask is if everyone can hear me okay. So if you can, raise your hand and we'll look at that first. Because it is okay. I can see you ready. Fantastic, you guys. So these are all recorded. Oh, look at all the hands. If these are all recorded, and so if you do get a little glitch or there's any type of little problem, just
Hope I
understand.
lost you there, Andy. Maybe it's just me.
Oh, maybe so. Okay. If there's a glitch or anything that happens, just know these are all recorded and every word will be caught and you can rewatch. And we're going to publish these as soon as possible after they're done. But for now, it looks like everybody's doing pretty darn well. And we're hoping
And
everyone's
I
safe.
just realized something, Andy. Will you upgrade me to organizer so that I can see the
Yes.
questions box so I can type in responses? I'll try to keep up. A lot of great questions come in, and I'm sitting here typing away.
Yep. Let
So
me do
stay
that now.
patient with it.
Let me do that now. That
Question,
usually,
it is not intentional, that's for
yeah.
sure.
And do Corey a favor. Everybody's typing in well. Do Corey a favor. Do your very best to to ask Corey questions on topic. Off-topic stuff we can send emails. If you want to know what his favorite set of flowers is for his birthday, that's off topic. Right? And so we welcome
Don't
you
send
guys.
flowers. Send
Send
something better
money.
than that.
Don't
Send
don't.
candy or
What does it
something.
say? Don't give applause. Just throw money. What's the old saying? I don't even remember what
There
it
you
is.
go.
So let's do our disclaimer quickly, everybody. We do this for education only, and we don't provide legal accounting advisory services. We do illustrations of investments. Now, I'm going to talk a little bit about this. I never gloss over the disclaimer, so let's talk a little bit about this. So, and I worry that this might happen. I cannot tell you when to trade and when not to. Everyone says, well, Andy, how do I know when I'm ready to trade? Well, I didn't know. How was I ready to know when I was ready to get married? I was never ready to be a father. There's really not a time I can think of where I said, yep, I'm ready to get married now, or yep, I'm ready to be a father now. But I also knew when I was 12 years old that definitely was not the time, right? And so it's a very difficult question because people learn at different speeds, people have different account sizes and stuff like that. So please, I send this with love and caring as an instructor. I'll give you an example. We did a trade here on gold, and obviously it did very, very well as we thought it would, right? And it's going to continue to do well for the foreseeable future. We're in a very advantageous position. There would be a temptation for sure for someone not to do one contract and do 10, and for someone to say, well, doggone it, this is money I can have. So please understand that I ask that you do these in a simulated account with me at the beginning so we can learn quickly. The market's not going away. There's going to be opportunities. I would not begrudge anyone protecting their account with a protective put, like we talked about, right? We're going to talk about protecting today. I wouldn't begrudge anyone with playing defense right now with the market the way it is. But this is a very offensive trade. Let's put this at the break-even point. We got a 95% chance of getting all the money. If we got out right now, it looks like we can clear $28 of it of the 38 possible. And of course, if we did 10 times the contracts, that'd be a $300 to $400 trade. So I'm here with my primary concern is to keep you safe. Now, what if it would have gone the other way though and gotten here? How do we know that delta hedging yet? Do we know that? We're still probably practicing some of that stuff. And so I just ask that you understand that respect this market and understand that we want to take great care of you. And the thing I'm here to do is help you earn money, not lose money. Don't want anyone to make the mistakes. Is that fair? Give me an oh yeah if you understand. Just type in I understand, Andy, if you understand. Right? Ruth has a good question. She says, everyone says, I understand. Gotcha. Ruth has a good question. How do I set up a paper trade account? Let me take a moment, and I know everyone's new, and there's some great resources in the Cashflow Academy for all of us. So let me go there. The Cashflow Academy. Need to learn how to type in my own website here. And there's some great stuff in here, right? If we go to the members section, we just put in my my little credentials here, whoops, and log in. If I put my stuff and log in. If I go into the Cashflow Academy members site, there's all kinds of stuff in here. Hit 30-day cash flow blueprint, and it'll give you the place to start here. That little what do you call it? The orientation that I gave you is here that explains it. Also, if I go into the Mentor Club, I can see that there's some bonus materials in here, right? And look at this bonus, setting up a brokerage account, how to choose a brokerage, the importance of paper trading, all that stuff is in there, particularly the Beginning Investor Boot Camp. The Beginning Investor Boot Camp is a camp done by Corey and myself where we take you through and we show you all kinds of how do I set up a paper trading account, how do I choose a brokerage, how do I do the paper trading. All of that stuff is in there, so make sure you use those resources. And with that, I'm a little hoarse still. With that, we're going to hop in, and firstly, let you ask you guys some stuff here. Have you guys enjoyed your education so far? Type in a yes if you're happy and if you're doing well. And look at a lot of yeses there. Okay, hugely someone said thank you. Hell yes, Curtis said. Loving it. It is so much fun. I've had letters from father-son teams and from doctors and dentists. We had a wonderful lady who's about my age saying, I never thought I'd go back to school this late in life, and she's about my age, so I know the feeling. Just wonderful, okay? Just wonderful. So an eye-opener. I love that. The head is swimming, but we love it. I love the comments. Look at this. Thomas says he's finished his 4 pillars. Fantastic. That's incredible, Thomas. Thomas, you like that? Maybe send a note on Ultimate Options if you want to keep going. So with that, Corey, let's go back and just review how this trade's going and start with our GLT trade, our first cash flow trade. And I'll set it up, or you can talk about it a little bit. Maybe I'll set it up again to remind everyone where we're at, because repetition, as you guys know, I tend to repeat a lot, which is a good thing. So what did we do here, Corey?
Yeah, so as the name suggests, this is a bullish put spread. So we were expecting the stock to go up, and this one's kind of interesting because it's somewhat non-directional, we would call it. And what I mean by that is we make money even if this thing goes sideways. We can even make money if it goes down a little bit, because what we're really saying is we don't think it's going to go down here. So if it goes up, great, we make our money. If it goes sideways, great, we make our money. If it goes down a little, that can still be okay. We can make our money. If it goes down a lot, now we've got a problem. So it is a bullish put spread. And what we did is we sold a put and made a promise. And we said, you know what? Gold down here at 136 seems like a bargain. Yep. That was the prior low. We looked at that chart and we lined it up with support. And we said, we're gonna be willing to pick up gold at 136. But then we said, well, wait a second. Do we want to be naked that option? Meaning, do we want to have a zero risk or a full risk, an unlimited risk below 136?
So let's stop right there. And I've circled this, as you can see, that then -1 on the quantity. The symbol is gold. The expiration is April 17th. We strike a deal at 136, and the premium we were paid is 82 cents. So all that information is right there. So get used to of translating, that line of -1 GLD, 17th of April, 136 put is the kind of thing we're doing 82. So if you can visualize this that I've drawn here and translate it to that, that's wonderful. So Corey had 82 cents in his pocket, right, Corey?
Yep, and that's a cash flow trade. That is a credit to our account. So that's money coming in. And remember, when you make a promise, you get paid, just like an insurance company does, right? If they promise to insure your car against damage or your house against damage, you have to pay them a premium. So we collected this premium of 82 cents, and we said, you know what, maybe we're not willing to risk all that the stock can fall. Maybe we want to draw a line in the sand and say, you know what, we want to have our own protective position. So of the 82 cents, we sent 44 of that on.
That's
and
right.
We bought our own protective position. And we have the choice, just as we made a promise to buy GLD at 136, we have the choice to turn around and sell it if we need to at 131. So if you have an obligation to buy at 136, if it falls below there, but you've locked in a guarantee that you can get out at 131 if it drops below there, how much do you have at risk? Well, if I buy something at 136 and then I turn around and sell it at 131, we know that we have 5 points or $5 of risk. That is our risk in this trade. Making a promise to buy at 136 and then being able to turn around and get rid of that at 131 equals $5. There is a little trick to this, though. We would call $5 your risk minus the credit received.
So we know that that right here we're receiving a premium. Let me get this on here. A premium of 38 cents. Well, if my math isn't too far off, let's see how I do here. Is that the 82 cents, 0.82 cents minus the 44 cents we got is 38 cents times 100 shares. That's where we get this $38 down here. And so if you look at this little box, 418.20, right? We should pick up we should keep that full $38 if we want to. And we can see that right now, if we wanted to get out and buy back the options we sold and sold back the options we bought, we could still keep $28 of that 38. But I feel so confident that this will probably stay up there. We have a 94% chance that this is going to work out for us now. Probably started off with about an 80% chance. Now it's a 94% chance. I think we could get the full 38. So again, we want the direction of the stock to go up. That would be great. That's bull. We've got a credit of 38 cents, and we're using put. So bull, put, credit, spread. So that's a quick review of that right there, and that's pretty awesome. We had a question here from Jordan. He goes, well, is 94 one standard deviation? Nope. Between this gray area is about 68%. That's a standard deviation, but our price is right here so far above our strike price that this would even have to go outside a standard deviation to be able to even touch this here. So it'd have to get wild and woolly for us to lose. Still possible, but at this point, not very likely. So let's see. How many have a basic grasp of that trade? Maybe you even copied it in a paper trade account. That's right, Jordan. That's a 95% chance of a win based on the software. That's exactly right. You have a basic concept of the trade. It made sense. Beautiful. Yep, I caught Christopher Pearson Smith. That's exactly what I like to hear. Yeah, I copied this in a paper trade. You might not have got the same fill price we did, but it's great. Patrick says, thanks for re-explaining this. Great practice. Yes, we're going to keep doing this over and over and over and over. Ryan, the word spread comes is because we're spreading the profit between two trades, right? We're spreading this 82 cent income and this 44% outgo. we call that a spread. We're just spreading the risk between these two and the profit between these two, and that's why they call it a spread. So people talk about, put spreads and vertical spreads and credit spreads and debit spreads and calendar spreads and diagonal spreads. All that stuff's going to come to jargon as you patiently, stay with us. But this is your first credit spread. This is the very first spread where we're bringing income in from one, and then we're spending. And we're actually going to do the opposite of this trade now, which is going to be a debit spread. And we're going to do this in the context of risk management. So who's ready for your next spread? Say, I am. Okay, here we go. Corey's going to keep working on these questions as much as he can, right? So
for sure.
You hammer on that. I'm going to set this up, Corey. You guys, Corey will answer a few questions while I set this up. I'm going to go ahead and get rid of this, and I'm going to show you something here. When I buy a put option, and I think I'm just going to use the SPY on this, Corey. And we're going to pull this off right here. In fact, we were fooling with this earlier. So let's just look, and I'm going to start with something here called the SPY. And I think there wouldn't be a more important or more practical trade to make right here than this right here in terms of education. Okay, this one might be really smart. So as you guys know, this is this looks like the S&P 500. And what the SPY is it's called an exchange traded fund. And what it is it takes whatever the SPX is. This is the S&P 500, S&P 500 index. Sorry, I don't write and spell at the same time very well. The SPX is the S&P 500 index. The SPY is the S&P 500 exchange traded fund, and you'll see that this is usually about 1/10 of the value. So let's just go over here and let's bring up charts side by side like this, and I'll put the SPX in this one, and you can see that these charts are largely the same, aren't they? They're largely the same in terms of how they look. Let me pull off the ATR right here just real quick. Usually it just lets me hit that and pull it off, but let's just edit the study here, and we'll pull the average true range off right here and apply that. And you can see these are almost identical. The only difference here is this is at 3,400 and this is at 340. And this is down here at 2619, 26 and change, and this is at 260 and change. So can everybody see that the behavior of these charts, if I didn't show you the numbers, they'd almost look identical, because the ETF tracks the index in lockstep pretty much. I mean, there's some difference, but very little difference, between these. Here you got a little bearish candle in here, and you don't have one in here, but for the most part, these are very hard to distinguish unless you see the name and the price. If you get that, type in I got it. I got it. That these are very similar. These are very much the same thing, okay? That this is an index. This is what you see on CNBC. So if I take the 500 large cap companies that make up the S&P 500, this is 500 companies, and they have what's called sector representation. They have, banks in here. You got tech companies in here. You've got all kinds of companies from different industries, and it's the S&P 500. It's 500 companies, and they add that together, and that's what the index is. So when you are watching CNBC, let's just go to a CNBC here, if we could, so you understand what these are. If you go to CNBC, let's just do that, CNBC, you're going to see the Dow Jones Industrial Averages. That's 30 companies that they put in and average together. Here's my S&P 500 at 2621, and our software is probably a little faster than their quote here on the web. So you can see that this is what we're looking at. So this is the S&P 500. This is the index. This is one of the major things people look at to see the market. Well, there's an exchange traded fund that instead of buying all these companies and you wanted exposure to this, to the up or the downside, you could buy this ETF called the SPY. So let's just type in got it again if you understand that correlation, that these are just similar investments. That's it. Okay, everybody understands that. Okay, now Alexander Lee says, well, what's the point? The point is that you can't own an index without buying all 500 companies individually. You can't buy this. If you hit a buy for sure, buy or sell on this, or try to sell an option, if you sold a put to try to own this, you can't own an index. But the point here is you can own this SPY. And this is something we can trade and use. So let's say that I had a whole bunch of positions in my portfolio, and I might want to manage those individually, but let's say that I just wanted a nice trade right here to manage the risk in case the whole market went down. In other words, I don't need to necessarily hedge every single position I'm in. It's not a bad idea to do it, but let's say I had a whole bunch of stock right now, and I said, look, I don't want to mess with that stock, but I would like, maybe I just want to hold it, but I would like something to protect me. I could buy this, and as the market goes down, it helps me hedge a little bit, if that makes sense. So here we go. Let's go back to just this one chart and take a look at it. Okay, this is a really nice, is this a really nice place to go right here. So watch this. I could do this. I could come in here and I could say, well, how much is a put option? Maybe I want a long-term put, and I'll do a little quiz here. When I buy options, do I want a lot of time or a little time? I'll just quiz you on that. Type that in. When I buy an option, do I want to buy a lot of time or a little time? Yeah, what's the analogy? Okay, so some people are saying a lot, some people say little. So I'm going to give you a little help and reminder on this. Let's do this. Let's look at milk. And some of you haven't gotten this far in your 4 pillars yet. But in the 4 pillars investing, we talk about this. So here is a carton. I'm going to draw this the best I can. 2% milk. Okay. And here is a carton of 2% milk. And they look the same, and here they are in the rack. Here's the back of the refrigerator rack here, and they're like this. And this one expires, let's say this one expires in 7 days, but you look back here in the back, this one expires in 12 days. So you're walking along and you're looking at milk, and I don't know about you, but I'm pretty tall. I'm 6'8". I got a pretty long arm. And I don't know about you guys, but you know what I do? When I go shop milk, I don't really pick up the one on the front right here on the rack. You know what? I'll take this nice long arm of mine and I'll reach way back here to this wall, and I'll come back and I'll just check to see if there's any expiration dates that have a few more days on them than the one up here. Any of you guys ever pull that? You guys, oh, look, even Jeannie says, even my husband does that. And Emmert says, yeah, I do that all the time, Rick. So if you're a buyer of milk, you want to buy a lot of time or a little time if you're a buyer of milk? I'll ask that question again, see if anyone changes their mind. Looks like we had a few people change their mind. Oh, I want a lot of, excellent analogy, Theo says. So I want a lot of this. Okay. Now watch this. This is the customer right here. This is you and I. And the customer is a what? Buyer. What buyer of milk? Now, back behind here, they can open this little door back here and put in more milk from behind the dairy here. So back here is you got the store manager right here. You got the store manager, and he is a what? He's a seller of milk. Well, which one of these does he want to get rid of first? Does he want to get rid of the long term or the short term if he's a seller? What do you think? Yeah, he wants to get the short. Oh, very nice. Very nice. So he wants to get the short term, right? And this is going to make a lot of sense. In fact, why don't we take a little picture of this? The concept we're doing right here is called time decay. So I'm going to take my ugly little pictures here, but we seem to like them. We like drawing with pictures here. And I'll erase my ink. Just give me just a moment here, if you would. Thank you. I'll erase my ink, and we'll just take this picture and we'll just set it to the side for a minute. And we might use it again, we might not. So that's buying and selling milk. Now watch this. If I have a graph of 3 months, 2 months, 1 month, and 0, this is expiration. And this is the premium. This is the time decay. So we'll call this time premium because options are made up of expirations, right? So here's my time premium. Maybe I got like $3 here, or let's go $4 here, and let's go $2 here, and then I'm out of luck right here. It's gone. Well, the way this graph is going to look is this is really exponential, is what it is. So it's going to look something like this, like that. And so if I look at the amount of time decay that goes from 4 months to 3 months, I'm going to get just a little bit of time decay like that. But if I look at the amount of time decay that goes from 3 months to 2 months, I'm going to get a little bit bigger graph like that. And if I look at the amount of time decay that goes from 1 month to 2 months, I'll put that in purple like that. And then I look at the amount of time decay in the last month. Look how much of that stuff I lose right here. Look at all that I lose. So you can see that about 2 months right here, right, we only lose on this side, we're only losing a little bit of price in time decay here. The freshness of that milk isn't too bad. I buy myself a lot of milk, and I buy myself a super thing of milk here. That first 2 weeks is too bad. But I'll tell you what, that last couple of days, look at this. That last couple of months here, we're starting getting chunky milk here. That stuff's losing value faster. So if we buy options, we like them on this side, and if we sell options, we like them on this side, if it's a single option. If it's a single option. There's going to be exceptions to that today, but just so you can kind of see the idea here, does that help with the time decay, guys? Is that a good lesson on buying and selling short-term stuff? Okay, pretty cool. Pretty cool. Leslie, if your broker says that, tell him, gee, I might have to switch brokers if you can't help me with that, because you should be able to protect and do that. So that's an interesting thing. And here's the other thing, Leslie, even if you can't do it in there, you can do it in a separate account, and it won't matter if you're buying to protect. So even if you put it in a different brokerage, you'd still be protecting your investment in the other one, because while your investment A drops, investment B goes up, and it doesn't matter which brokerage is in. I thought I'd just answer that out loud before Corey had to get to it. Okay, what I love is Ruth here. She says, this is getting clear. And that's exactly right. You don't have to have everything perfect today. You just say, oh, it's getting a little clear, Now watch this. So I'm going to quiz you guys and see how well you're learning, because you're still new. That if I were looking at the S&P 500 right here, which we are, this SPY, we've had it come back up off the bottom for a little bit, right? Okay, I'm going to quiz you. Do you guys think 220 is the bottom of this thing? You think this 2020 point in the S&P is the bottom of this thing? I'm going to give you this. It could go back down and further. It could go up and recover. It could stay the same, or none of us have any idea. Let's see what we think. You could say it could go down lower, it could go up higher, it could stay the same, or none of us have any idea. That's right. None of us have any idea, right? No idea. I don't know. You don't know. And if I was, on the president's council, or if I were president of the United States right now and I had all those guys around me, the first rule I'd make is don't give me any frickin' opinions here. Give me facts, right? If I have to make decisions with people's lives right here, I don't want your opinion, doctor. Give me the data. Give me the frickin' facts, right? I'm going to deal with facts. And so I need to look at this from a factual standpoint. So the way I might look at this is I might say, you know what? I'm going to buy some insurance right here. It seems like we've had a nice retracement. We could pull out our Fibonacci bars. We're not going to do that right now, but I think, you know what? Just in case it goes down here, I'd like to buy some insurance just in case. Maybe I just bought some stock and I've got a good cost basis in here. I bought some stock. I think I got a good low price on sale, but I am nervous about it falling down just in case. Do you guys know whether your house is going to burn down this month? Do you know whether you're getting an auto accident this month? Do you know whether or not you're going to need health insurance this month? So even though we don't know that this might go down, it might not be a bad idea to buy insurance. Who agrees? So yeah, maybe it'd be a good time to buy a little insurance right here. That's exactly right.
Andy,
Yes, sir.
Andy, to your point, we don't know what the future is going to bring, but different traders might go about this in different ways. For example, I love that you're using this as an insurance example. And if you're insuring something, you might be more willing to get in, even if you feel like you're a little bit early. Whereas a
Yep.
trader that says, you know what, I'm not insuring anything. I'm just looking to be speculative and profitable if the market drops. They might say, well, I'm going to draw a different line. I'm going to wait for the market to come up here and fill the gap up in 270. And so as a trader, you can identify the levels where you're willing to get involved, where you say that the risk to reward for me is good right there. But understand, insuring versus entering a new trade are two different things. Would I be willing to put this on early on an insurance from an insurance standpoint? Probably would, because if I had a big portfolio of stocks, I would say, you know what? I'm not willing to stomach all the risk that we go to new lows. So maybe I just put on some insurance here. Whereas if I was looking for a new bearish entry point, I might look back on the chart. We don't know how the future is going to look, especially in this market environment where news is coming at you fast. The latest data for coronavirus, the reality is even the experts don't know what's going to happen exactly. So nobody knows for sure how this is going to go. I could look at it and be strategic and say, well, if the market gets to my price, great, I'll enter a new trade. And if not, I'll pass on it, right? So there's a different mentality between getting into a new trade versus protecting, hedging. Yep.
So maybe what we do, Corey, is we look at these puts right here and we say, you know what? Let's give ourselves a couple $1 deductible right here, right? Give ourselves a little room so we don't get freaked out. And let's start with the long put first, Corey. What do you like for a long put? Just close to the money. We're out here in June. We got a lot of time. These are pretty expensive, but that's all right. What do you think?
Yeah, and I think anywhere around kind of where you're at, and you might even look at it and say, let's go down to this, in trading, we'll use the easiest numbers, maybe the 255. So the 255 is going for about $19 and it's moving, but 1930 or something like that. And we could look at protecting ourselves. Notice that the asset is trading close to 260 per share, but we're buying our protection at 255. They call that a slightly out of the money option. It's just 5 points down from where the asset is right now.
So let's just draw that. I'm going to show you guys something I think you're really going to like. So right here, let's draw Corey once again. And remember last time we sold the option on gold. This time we're going to buy it. So Corey says, look, I want some insurance. I say, I want the choice to sell my SPY at $255. Let's highlight that so everybody can see it. At $255 anytime between now and, let's just slide this over just a hair so people can see it, June 19th. Okay, June 19th. So that's great. And that's going to cost
And
him about 19 bucks. We'll see what it is exactly here in a second. Go ahead,
yeah, and
Corey.
you don't even have to own SPY. You now get to sell it at 255 no matter what. So you might have a portfolio of stocks, and professional traders will often use the SPY or the S&P 500, a broad benchmark, for hedging purposes. And they'll say, well, I want to lock in the ability to protect my portfolio. And if my stocks are going down, if the market's going down, my stocks are probably moving with it. You saw that here on the coronavirus scare. All stocks went down. There was nothing, really that was staying up. They sold everything indiscriminately, and that's the broader markets. Everything in the S&P 500 was basically falling. So we're saying, I like my stocks better than the market. I think my stocks are strong or whatnot, but I might buy the SPY to hedge that. Or you could own the SPY. You might even own stock in it, and this would protect it the same
Now,
way. So it's kind of a portfolio hedge or an individual stock hedge.
now this is great by Vera, and I love this because we use jargon sometimes. Be careful. When I say a long put, that means I own it. You might have heard of going short and selling short and betting stuff goes down and stuff you sell. So a long put means that I'm going to have a plus sign on here, right? That I own it. A short put means I'd have a minus sign on here. Does that help, Vera? So we're actually going to spend this money, and Corey's going to spend this money. Now, the other guy or girl on the other side of this trade, we'll call this Sally Investor. Investor. She is receiving this money because she says, okay, Corey, you want the choice to sell or option to sell? I promise you I will. So Sally Investor says to Corey, I promise to buy this from you no matter how far down the market goes. I promise to buy this SPY from you at this $255 deal. So now Corey can breathe easy and say, well, now if the market falls and this S&P 500 falls down below 255, 254, 253, 252, all the way down to zero, we have a guarantee that we can sell it to her at 255. So how many understand we've bought insurance? Yes, Emmert, you don't own the stock on a short put. You've just made a promise. Okay, everybody's understand this really, really well. Yes, I get it, Dana says. Great job, Dana. Okay, this is not a cash flow trade, Tom. That's correct. Great job by you, Tom. We're buying insurance. So think about this. When you buy car insurance, does that cash flow to you? No, but if you're the insurance company, it cash flows. When you buy milk, does that cash flow to you? No, it's a purchase. So we're making a purchase right now to protect ourselves, right? To protect ourselves, okay? So when we're long an option, this is just jargon. This just takes a while to learn. When we're long an option, we're going to see a little +1 right here that we buy it. Watch this. If I was short the option or selling the option, put a -1 here. So this, watch, a long option is when I buy the promise. See? So Corey on this option is what we call on the long side. Let's just put it that way. He's on the long side of this trade because he is making the purchase. See where the premium's going? See where the money's going? But Sally over here, she is on the short side. So on Corey's side of this trade, he's going to look at this. Let me finish writing what I was writing. Okay, short side. Because whoever makes the promise is the seller of the option. See how Sally is receiving this money? The money's going towards her for the option. So since Corey is purchasing this option, he is on the long side or on what we call the buy side. If we were to switch over and make the promise, we say, I want to sell the option. See, now we're on the short side. See, but let's go back and on the long side. Does that help you guys a little bit with that jargon, long and short? The person who makes the promise is selling the option. They're receiving this money. They're on the short side. But the person who is buying the promise, who's spending the money, He has the choice. He owns this option now. She's made a promise. He's made a choice. He gets to make the choice. Does that make sense to everybody? Getting
Andy,
better.
a good question. A good question that came in is, what if we don't own any stocks or we don't own any shares of SPY? Then it's not a hedge, is the answer. Now we're not hedging anything because we're not protecting anything.
That's right.
So if you don't have anything in your portfolio and you come out here and you buy this put, now it's just a trade. It's a speculation.
Yep.
And in that case, it's a bearish speculative trade because, and we're going to give a name to this strategy, the bear put spread, because you're bearish and you're trading a put spread. So on GLD, we did a bullish put spread where we sold a put spread and got paid money, betting that it wouldn't go down to those levels. Here, we'd be buying or entering a bearish put spread, speculating that it is going down. So if it's against a portfolio, it's a hedge. If it's just you don't have any stocks,
you're
then
betting
yes,
it's
you are
going
just
down.
speculating.
Yeah, you understand that if the market were to go down to 200 and Corey can sell at 255, that option be worth $55 now, and you can cash in for $55. So if you don't own the stock and it went down to 200, you just made $55. If you own the stock, you'd lose $55 in your stock, but you gain $55 in this option. So it gets a little wonky. It takes some time. I'm really thrilled with how you guys are going. Someone said, this has been a bit of a brick wall for me. This is really helping. Well, good. I'm glad. That's why we're doing this over and over. Can you guys see why it's kind of good that you're here, because this is tough to teach really, really fast, right? There's a lot to do, a lot to learn. And it's funny because some people want to show up, and I was laughing. I was on an airplane once with a medical doctor, and I was going from Salt Lake City to Atlanta. And for 4 hours, this guy told me about his degrees and his 20 years of education, his graduate school and his graduate work, and then beyond that, his certification. Guy had a 20-year post-grad education. He's a brilliant heart surgeon. And then at the end, when we went into the approach, the loudspeaker said, "We're now approaching our last, descent into Atlanta." He turned to me and said, "Well, what do you do?" And I said, "Well, I trade options and stocks." He goes, "Hey, you got any tips for me?" And I kind of felt a little sheepish because I thought, I just sat on a plane, bud, and listened to your 20 years of education. It was almost like I know I'm not ready to do open heart surgery. I wanted to look at the guy and say, "You're no more ready to trade than I am to replace a bicuspid valve." So can you guys appreciate that what we're doing here is we're catching you up as quick as we can. You guys are doing such a great job because there is a learning curve, right? There is a learning curve. How many wish you'd have started this a year ago? Right? Got this jargon. Yeah, me, yes. But guess what? Better late than never, right? And we will get you there. We'll keep going. You're going to learn what long and short is. What I love about this particular group, and for most of you, you realize that, if you don't understand long side and short side your very first day, you probably will get it eventually, won't you? Yep. Oh, you're so nice. You guys are saying nice things about Corey and I. Well, I appreciate that, right? Oh, Marianne, don't feel that way. She says, "Well, I feel dumb learning options." Nope, this is going to be simple, but the key is reputation. The key is repetition. Thank you. Repetition. So this is fantastic, right? And this is also why we make paper trades first before we do this real, right? We make paper trades first. Zhu Chen Hao, he says, if I'm understanding this correctly, for any trade we do, we want to do this. I'm not sure I'm reading this question right. Yes, we want to have methods to protect our other side. So let's see if we understand this put option basically right now. Corey is going to spend some money and give it to Sally. In exchange, Sally is promising to buy this stock at $255 no matter how far down the stock goes. Obviously, Sally thinks it's going up, doesn't she? She thinks it's going up. So Corey is now protected that this market could fall all the way down to zero, and she would have to buy this stock at $255. Give me a yes if you're understanding that, right? This is an insurance policy. Everybody's getting it. Oh, you guys are so awesome. You're so good. Okay. Now, here we're going to do so we should understand that. And anyone that buys a put option, call your broker. Say, hey, I'm learning about put options. I'm still learning short side long, but at least I know one exists. You'll be surprised at how many brokers. Some of them say, oh, you can't do this with your 401k. Well, yeah, but I can still hedge my 401k. We had one question. Someone said, hey, my broker won't let me do this in my solo K. Slap him. Say, well, open me up a separate account, dummy. I can still protect it in a separate account. I mean, he should know that. So one thing you got to know is that people with a Series 7 are usually salespeople. They're usually young guys right out of college. Maybe Corey could speak to this a little bit. I shouldn't do it, but I have a little clip that I played the other day of being on the phone with Ameritrade. Finally got someone up to the options desk, and he says, yeah, Andy, I'm sorry. These guys couldn't help you. Your portfolio is a little more complex, and you really need an options guy to help this. So you're going to really find out a lot about your own financial advisor. Is if they don't know what a protective put option is, then they need to go to school and tell them to call me. I'll give them a deal and get them in here, and we'll teach them what a protective put is, because they should know that. So here's where we're going to go to a new level on this. You guys ready to go to a new level? Say yes if you are. Okay, we're going to go to a new level right here. This should be a good time. Okay, new level. So this ensures, if we look at a stock chart here, and Corey, you can chime in on this if you want. So this is going to ensure everywhere from 255 down to the market going to zero. In other words, what would happen if it went to zero is you would look at CNBC, right? Let's see if I can bring this up here. You would look at CNBC, and instead of having a S&P 500 at 2623 here, you'd wake up in the morning and said, well, the market's disintegrated. All 500 companies have gone bankrupt. All 30 have gone in the Dow. We have, it's complete. None of them are in business anymore, and their stock is worth zero. Now, while things might get bad, I don't know that they're going to get that bad to where all 500 companies are going to go bankrupt. You guys agree that they're probably not going to go to zero, right? Probably not. Yeah, then Kenneth says, then we have a lot to worry about right there, right? Yeah,
again, then it brings up all sorts of questions. Is your cash worth anything?
Yeah, Well, now we're basically back to sitting around the campfire like cavemen, trying to go out and run down a deer or fish out of the ocean, and we're pretty much back to primitive times.
Yeah.
So think about this. You guys are insuring. Now watch this. I think you'll like this idea. You guys are paying, or Corey's paying, almost $20 to insure something that might not happen. You follow that? He's worried. He's paying for insurance, the full gamut. I mean, he's paying for all of this, right? He's paying for the whole dad blasted thing. So think about this for a moment. What if we said, hey, we think that we might want to insure this to maybe 2,000, or in the case of the SPY, 200. In other words, we don't want to pay $19 to insure the whole kit and caboodle here. We're not looking for, insurance that if the car is totaled, we just like about $55 worth of stuff right here. Maybe we wouldn't have to pay as much if we don't want to insure the whole thing. Because $20, I mean, hey, I know you're getting until July in this thing, but $20 is $20, right, Corey? So watch this.
And if we're insuring down to 200, that's about 21% lower. How many of you think that the market can go down 20% between now and June?
Oh,
are we going to zero? No. How many of you think that it's possible we can go down 20% between now and June? Certainly possible, right? We just fell, 30% in a straight line in a month. Maybe 20% more is possible.
Possible. Okay. Now, Darlene, I love you. Darlene says, where can we see a list of companies in the S&P 500 or the Russell 2000? Well, guess what? We could probably do that. But right now, Darlene, I really am going to encourage us to just focus on this right now. And then we can worry about the Russell 2000, okay? Because I could break right now from this and we could go look at, different stuff for the Russell 2000, but let's just be patient right now, and we'll concentrate on this. We'll worry about the Russell 2000 because we can do this on the Russell, but for right now, let's really stay focused on this idea. Okay, am I okay with doing that? Awesome. So watch this. Let's take a picture of this trade right here. We'll go one trade at a time. I think you guys are really going to like this, and it's a very simple trick, but if you haven't had training, you might not really think to do it, right? So with training, we'll think to do this little trick. So let's get rid of this, all this ink, and let's take this out here, right here, and bring this over like this, okay? And just watch this idea. What if we did this? What if we said, I would like the ability to sell this at 255. Great, fine and dandy, but let's put Corey here again. Corey here again. And let's say that Corey doesn't want insurance for there, maybe at 2,000. So maybe he says, look, I want the choice to sell this at 255, but you know what? If it gets down that low, we might have some bargains. So what might you say, Corey, right here?
Yeah, maybe I'll make a promise to turn that stock over. Maybe I'll make a promise to buy down at a lower level. So I have the choice to sell it at 255, and then I'm basically setting up my exit price. I say, okay, I'll promise to buy it back at 200 in SPY. And if I make a promise, remember in the options market, anytime I'm making a promise, I'm getting paid money. So there's income coming in. I paid a premium on the top because I wanted to have choices. I make a promise on the bottom, and now I'm going to collect the money. So just as Sally collected the money from me up there, I'm going to collect some money back from Joe here by making a promise at a different strike price. So I am spreading out my risk. I'm saying, well, I'll have the choice to sell at 255, and I'll make a promise to buy it back at 200. Okay. And they're going to pay me something.
So look at this. Look at this right here. That's $5.90 right there. So watch this. $5.90. In fact, it's close to $6, but we'll call it $5.90. We'll call it $6. I mean, the mark's at $6. So look at this. Corey's going to get $6. So think about this now. Now he is insured from 255, where he can always sell, down here to 200 instead of to 0, but he collects $6. So if he's going to pay $19.20, but he's going to receive $6, what's his new cost for this position? Who can tell me? Who can do that math? Because I'm not smart enough to do it. Can anyone do that math for me? $13.20? You guys are good with your math. So now, instead of paying insurance, so this amount of insurance costs $19.20, doesn't it? But this amount of insurance now only costs me $13.20. That saves me almost a third off, almost a 33% discount for protection in this area. So I'll bet if we do a risk graph, this will really help us see it in a risk graph. So we have two trades here, right? Let's get this one in ink too. We have two trades here. We have one where we're paying $19 to manage the risk clear down to here, but we say, you know what? We're willing to buy here and insure someone else from here to here because we don't think this is going to happen. So why insure the whole thing? We'll just insure this part of it and get this money. So watch this. And this will become a lot more clear when we build the risk graph here. So I think you guys are going to like this, and this is pretty slick little trade we're going to do right here. And the reason we're showing this one is this isn't necessarily a cash flow trade. And usually we almost do all cash flow trades. But in this environment, when we saw the chart and we saw, oh, this thing's creeping up right here. Maybe people think this is over. It might not be over. People might want to learn how to insure, maybe from our insurance, which is going to be from here at about 250, 255, right about here to where? to 200 so we can insure that new portion in case it breaks through that and we get down to about there. And that might be a nice little area of the market to have insurance on right now. Might be. So let's build this trade out, okay?
Yeah, and a couple of questions are coming in about these two different strike prices. So let me ask a question. Think of it from this standpoint. Which of these two options is most likely to be hit? Are we more likely to be below 255 or more likely to be below 200? The reason that the 200 strike is less money is because it's further out of the money. In other words,
away.
The only way you get below 200, you have to be below 255, right? You can't skip it.
Only what does that say? A 16% chance of getting down this far.
Right.
25% chance of getting this far. 50% chance of getting this far. So there's a much greater chance of getting to this place than getting to, down here.
Correct. And so we've bought insurance that kicks in first. Our insurance kicks in if we go below 255. We have the ability to sell SPY and get $255 per share no matter how low it goes.
Right.
What the 200 strike does is basically says that's where our insurance stops working. At 200 and below, our insurance is capped. We have partial insurance. We don't have catastrophic. We're not protected down to zero. We're protected from 255, and then once we get to 200 or below, it stops insuring, and we've just got $55 of insurance. That $55 difference between the strikes.
So watch this. I'll uncheck our short option, and we'll just look at this first trade by itself. Watch. This first trade by itself, 19 times 100 is 1900 or 1920. And look at our little box. Look at our little box down here with 620 on it till June. It's a June. I thought it was July. It's June. So can you see how that costs us 1920 on our risk graph? And if the market goes up, we're out 1920, right? We're out 1920 for insurance if the market goes up. If it goes down, look at all this money we make clear down to zero. Clear down to zero. But we probably don't think it's going to go too far past 200, right? So, 3,000 or 4,000 is where we think. Now watch this. Instead of 1,900, if we sell this option, boink, it caps our gain at 4,180. But look, now we're down to 1,320, just like you guys did on your math. Now we're down to 1,320 of risk, where here we were at 1920 we could lose. Now we're at 1320 we can lose. And as the stock goes down, this is the portion that we're saying we're most nervous about. From 255 to 200 now, this is the portion we get paid on. We're not going to get paid any more as it goes, below that on this one, but we think that this scenario is less likely to happen, right? We think that the biggest slide would be from 255 down to 200. So can you see how this gets rich with cash between as the stock falls from 255 to 200? We get paid handsomely. In fact, at expiration, you can watch this little box here at 4180. We go from paying for the insurance to rocking it here. Now, here's what's beautiful is our timeline is very forgiving. Our purple line is very forgiving, because this is a long-term option. It's going to take us a long time. The reason we went out this far are we more of a buyer than a seller? Well, this is a good thing. Even though we were a buyer of this one, a seller of this one, someone might say we're a net buyer. Why a net buyer? Because when you put these two together, we're still spending $13. So are we more of a buyer of milk or a seller of milk? We're more of a buyer. That's why we do the longer term, because we're more of a buyer. And you'll see that it takes a long time. Watch this. See, I'm marching this forward, and you can barely see the purple line move as I'm marching forward in this date down here. Barely see the purple line move and lose value of our options. I just went clear into May. Let's go back to today. And so we're going to have a very forgiving line here, but if it goes down, we're going to be protected here. How many like that trade? Say this is pretty cool stuff. Kind of a medium, not really an advanced trade, kind of a medium trade. Okay. Chile. Someone says this isn't just cool, it's Chile. Okay. Oh, market closed. There we go. Market just closed. So we've been in an hour. So let's see if we can figure out the name of this trade right here. And I'll see if I can't place it today because the market's closed. So we'll have to try to place it tomorrow. I'll do my best. And we might get better prices. Right now it's a little cheaper, 868.
Oh, Andy, these usually trade 15 minutes after, so we can maybe sneak it in there. See if our...
You know what? Let's see what we get filled at. Let me see if I can sneak this in. We'll confirm and send
the
that.
midpoint.
And yeah, it'll give it to me. I just care about getting in the trade. So we'll see if they go in for me. I opened them up so they hopefully can just work for me.
Gotcha.
So we'll see if they do. If not, I'll put them in again tomorrow. What I can do though that's important is I want to
that's a little tricky thing about these SPY. I had questions about that. These major market ETFs like SPY and some of those trade for 15 minutes later than the usual market environment.
Yep.
So your stocks will close trading at 4 p.m. Eastern time. The Apples and the Amazons of the world. SPY trades for an extra 15 minutes after that.
Now, here's why I thought this would be a good one to show you guys, okay? Now, right here, and another reason this might not have gone, Corey, is I don't know if they trade after in the simulated or not. I don't know if they do.
They might not. I don't know the answer to that.
Who understands, am I in a real account or a simulated account right now? Which one? I had someone ask, they didn't know the difference, so I'm going to see who else might have that question. This is a paper account, right? Now, this is what's really cool, right? So I have lots and lots and lots and lots of stock. And if the market goes up, I'm going to make money in my ExxonMobil and my KHC and my GLD and the other stocks that I own, right? So if I go up, I'm going to make some money. Now, I'm going to lose a little bit. You can see how I'm losing a little bit of money here. And this is a 3,000 S&P. So if we start going up to a 3,000 S&P here, I might lose $800 on my insurance. That's a good thing. Remember, you don't get a rebate on your car insurance, and you don't get a rebate on your home insurance, and you don't get a rebate on your health insurance unless things go bad. So this is what we call a cost of doing business. But guess what? If we get to a 3,000, if we cover to 3,000, I'm going to make so much money on my stocks, that's more than going to overcome my $750 loss here for my insurance, isn't it? Does that make sense to everybody? Let that sink in. Oh, if the market goes up, yeah, I'm losing money on insurance. Just like if I don't wreck my car, I pay my insurance. If I don't burn my house down, I pay my insurance. But my house is getting more valuable, right? And so check this out. If the market tanks, then I'm going to get paid $4,000 on this insurance if it goes down. And guess what? I get to keep my stocks. So I can let my stocks kind of go down a little bit, but this pays me and kind of gives me a little love here. If they go down, I might use that $4,000 to buy some more stocks low because I don't lose my stocks in my portfolio. So all this trade does is, yeah, it's going to cost me a little bit if it goes up, just a little bit, but it pays me huge if it goes down. See, this is a little tiny bit, but this is massive down here. And so this can be a nice trade for me to say, well, if I'm an investor, not a trader necessarily with my stock. So if Delta goes down and Exxon, some of the trades I've already shared with you go down, well, great, I get to keep those stocks, but look at the bank I make on the S&P going down. And if it goes up, well, guess what? I'll make so much money in those stocks, it'll overcome. Notice the risk-reward ratio. The risk is very small here by buying the insurance. The reward of the insurance is massive if it goes down. So, it goes up a little bit. My stock should very much overwhelm that premium loss. But if it goes down, I get to keep my stocks anyway at those lower prices. Yeah, that sucks. I took a hit on my stocks, but I get paid huge here. And what's fun is let's say I have a bit bigger of account, right? And so maybe I go 10 and 10 because I have a little bit bigger account. Now, now that's 40 grand. See, that's $40,000 down there. How many like this stuff say this is freaking ingenious right here? Daniel says, this is very, very smart. Someone says, I'm not a genius. Okay, let's not get crazy, but Theo says, you're the effing man.
I like that.
Okay.
One.
Now, Verissa Lockhart says, Verissa Lockhart says, that's kind of tough. So, Verissa, I'm going to help you with a picture. Okay, watch this. What is a hedge? And again, you're going to be able to repeat this. You're going to be able to go over it. But watch this. Here's a teeter-totter, right? A little teeter-totter. And let's say that I have a scale over here where I have it 1 to 4, and here I'm $0, $1, $2, $3, $4. And let's have a teeter-totter here. Well, I didn't make this very good. Let's make this so it's visually better. There we go. The teeter-totter here where I have 4, 3, 2, 1, 0. And let's say that for every notch this goes up, I make $1, and for every notch this goes down, I lose $1. So right now, if I add this up, if this is pointing at 4 and this is pointing at 0, how much money do I have? Who can tell me? How much money do I have? If this one's pointing at 4 and this one's pointing at 0, I get to add up both total. Yeah, I got 4. Okay, great. I got 4. All right, let's draw a different line. Let's say that this one's pointing at 1. Well, that's going to put, if this one goes up, then this one's going to come down. This one's pointing at 3. So this one went up 1 and this one went down 1. How much do I have total? If I have 1 over here and 3 over here, what's my new total in my account? Oh, 4. Oh, 4. Chris says, are you serious? You're teaching us how to build teeter-totters? 4. Well, actually, I'm showing you how to build a hedge. Okay, what if we level it off and this one goes up 1 and this one goes down? What do I have now in my account? Yeah, I have 2. Or excuse me, I have 4. 2 plus 2 is 4. I'm running out of colors here. Let's go sky blue. Guess what? I got 4. And let's go to brown. Guess what? I got 4. So this is called hedging. So what this means, and I want to give an awesome shout out here to who has said she was struggling with this. I can't see your name. Oh, it was Veressa. I want to say that. Veressa, is that it? So Veressa, watch this. Let's look at Andy's account in the same way, not in a teeter-totter way, but let's look at Andy's stocks. Okay, so here is Andy's stocks. And let's say we got Delta Airlines in here that I just bought, Exxon Mobil in here that I just bought, and KHC, which I've had and I own a lot of, and, just stock after stock. Well, if the market goes down, I'm going to lose money in those trades. So Andy loses money in his portfolio. But remember, over here, I have this SPY trade that what happens to this SPY trade if the market goes down? Oh, I make 40 grand in this one because I got 10 of them, right? So as my portfolio goes down, I get paid huge in this trade and it balances out. That's called a hedge. See that? That's called a hedge. So even though I'm losing money in this one, losing money. Yay, I'm making big money in this one. And guess what? I get to keep these stocks anyway for them to recover someday. So as this falls down, I take this money and then I just wait for these to recover someday. How many like that hedging stuff right there? Do you like that hedging stuff? Versa. I'm doing my best. I have bad speech impediments. Now, here's the interesting thing. I got a clap from Dana Hawthorne gives me a clap. So look at this right here. So the idea here is someone said, well, they won't let me do this in my 401k. I called my broker. Okay, fine. Let's say this was my 401k. Let's say this is my 401k and it tanks and it dives and I lose a bunch of money. Okay, what if I had a TD Ameritrade account with this in it that my idiot broker didn't even know about? My idiot broker that doesn't know how to hedge. Okay, fine. I could buy this in my own account and he wouldn't even know about it. I'd still make this bank over here even if I lost my 401k. See that? So it really doesn't matter, right? It really doesn't matter. Now, David says, do I hedge 1-to-1? No, not usually. That's a different thing. Daniel says, this is freaking exciting. Yeah, it is. It really is, right? Okay. So yeah, this is good stuff. I mean, I love owning stocks and I love owning this. I could do the same thing. This hedging concept is important. Watch. Let's say that it wasn't even stocks. Let's say I own some gold over here on this side of my asset column. Right, here's my asset column. Over here's liabilities. Let's say on this side of my asset column I own some gold. And on this side, I have the US dollar. Well, guess what happens when the US dollar goes down? Gold goes up. Guess what happens when gold goes down? Usually the US dollar goes up. So the reason I, right now in this, tough time, I've got a little bit of this, I got a little bit of this, right? And I also have some stocks that I want to hedge. So hedging is simply this. Hedging is when we have one investment that will go up if the other investment goes down. They're called inversely correlated. So that's a fancy word. This SPY trade is inversely correlated to my portfolio, meaning that if my portfolio goes down, see, my stocks go down 300, 250, 200, 150, 100. If the stock market goes down, this trade makes me lots and lots of money. Let's not do that big of a one for this group, though. That's a little psycho to do 10 on our first one. So let's go down to one simple contract. We're just starting out here. So here's the big picture lesson. If you get this big picture lesson, I'm happy. Okay. If you still need to review some of the jargon of, okay, this is the short one and this is the long one and this is the expiration and this is the strike, and I'm still learning these two sets of transit. That's fine. You'll get this over time. Do you believe me? If we keep doing these, it's going to click and click over time. But here's one thing I hope you get now. How many understand that all we've done here is create an investment that makes money if the market goes down to compensate us for other investments? Who gets that? That's the big picture. Kenneth, I couldn't be happier. When people get the big picture, then they know which direction they're headed. But some people, thanks, Theo, we try to make it simple. Thank you. Great job, Kenneth, right? Okay, how do you get the details? Repetition, take your classes. Some of you aren't even through the 4 pillars yet, right? This is pillar number 4. This is hedging, right? This is pillar number 4, risk management. So that's cool. Danny says, how do I place more than one put option? Well, you click that. Watch this. Now I got 2. Now I got 2 here. And now I got 3. And now I got 3 here. And now I got 4. Now I've got 4 here. So that's how I do more than one. So I'll take that back down to 1. Good question. Take those back down to 1. All right. Million different things, right? So Felipe Gonzalez says, give me the big picture again. This is a trade that makes money if the market goes down, which offsets money I lose in my portfolio, right? If things go down. One option is 100 shares, Tom. Very good. Yep, one option covers 100 shares. Mary says, I'm starting that risk management 4 pillar after class day. I don't blame you. I don't blame you at all, right? Can this software program put out false info? Yeah, I guess anything's possible, but it's generally pretty accurate. I've been trading for how many years, Corey? I don't know how many years, and there's probably only been 1 or 2 times where I've been suspect. And it's kind of like this. This is a good question if you're worried about, will this software work? Well, once you learn how to trade, for example, there's been 1 or 2 risk graphs that were too good to be true. And so sure enough, I took a screenshot of them and I called the brokers. I go, are you guys having data problems? Because I got a risk graph that says I can't lose here. And, this doesn't seem right to me. And they go, oh, yep, you're right. We are having a glitch. But that's probably happened once or maybe 3 times in 20 years. So that isn't a big deal usually, okay? This is important when David says, who provides insurance? It's not really insurance. It's really that I just have 2 trades that provide a hedge, right? So this isn't like an insurance company where I said, okay, Geico, insure my stuff. It's just the fact that I have this trade in and of itself that, notice, if the stock price, please watch everyone, if the stock price goes from 300 to 250. Let's get some prices in here that are easier to see. So if this market goes from 260 to 250 to 240 to 230 to 220 to 210 to 200, I'm making money, right? So the only reason I call it insurance is I have promises, right, from this person. I promise to buy SPY at 250. I simply have a promise that I've paid for that benefits me. So I pay a premium to this person, and they're the one really providing the insurance. It's not Geico or Fidelity. It's another investor, right? Another investor has made me a promise to buy this high in case it goes low, and I paid them a premium to get it. So so insurance is a good analogy. It's a good way to put it. And sure enough, it's absolutely true. If this market goes down, we're making lots of money here. If this market goes down, we're making lots of money to help offset any other stocks that we might have. So that's fine. No Bermuda Triangle right here, unless you want to be on the, it's not going to, you have fixed risk here. So no Bermuda Triangle here. Fantastic. So we're going to name this trade. Okay. We're going to name this trade. The name of this trade, let's name it. These two together. Okay, first, whenever we name a trade, we do the direction first that we'd prefer it to go. So in this particular trade, does this benefit from a bull market or does this benefit from a bear market? Does it benefit if the market falls or goes up? Bull or bear? Ready? On your mark, set, go. Bear, 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 bear. Very good. 100% right. Grr, Tom says grr instead of moo. So I got it. So yeah, we'd start off with saying this trade is a bearish trade. So the name of this trade would start with bear. Okay, are we using puts or calls to make this trade? Puts or calls to make this trade? Everyone got this right. We only had one. And you know what, Ian? Ian has a question mark. Good job, Ian. That's just honesty, and it's okay. I will tell you, Ian, right now, I didn't understand this the first time it was taught to me either, so don't worry about it. So we have bear put. Okay. Now, are we getting a credit? In other words, are we getting paid after we pay out this and receive this? Is this a net credit or a net debit? In other words, we're paying out 19, we're only receiving 6. So at the net, are we paying out more money in a debit or are we receiving more money in a credit? Credit or debit? On your mark, set, go. This is a net debit. Great job, Gideon. Gideon had a question mark by Gideon. Come on, Gideon Dominguez. You had that right. There are no question marks on you. Yeah, this is a debit. So it's a bear put debit. Okay, and are we doing one option or are we spreading this across two? Is this a single or a spread? Single or a spread? God, you guys are so good. I can't even stand it. This is so good. Bear put debit spread. And Corey's just answering questions as fast as he can. So the name of this trade.
I'm trying to keep up.
The name of this trade is a bear put debit spread. So before we did a bull,
that I think really helps people is with this risk graph. Look at I think we already established I'm colorblind. So that blue, that kind of turquoise color.
Yep.
That's your most important risk graph in that's showing what your trade will be worth at expiration. So that is, if you put this trade on and you hold it all the way to expiration in June, that is the result. This is what you get out of it. Now, if you look at that and you simplify the risk graph, on the left-hand side, you'll see a 0. That's your break even. That means nothing was gained or nothing was lost. Above that, you've got all your profit areas. And below that, you've got all your loss areas. Now, where are you hurt in this trade? Look at the stock price down below the stock. What are the stock prices that hurt your trade? Where do they end up negative? Well, they're all up there at 255, 260, 270. See all those stock prices down below? It's telling you if this stock goes up, if SPY is up at 260, 270, 300, anything there, we're down here in the negative area on this trade. So that's no good for this trade. If SPY goes down, so now look down at the stock price down below, 230, 220, 210, and of course at 200, that's where our gains are capped, because that's where we sold that lower strike option. That's where we max out our profitability. And in this case, if it's at 200 per share or anything lower, 190, 180, 170, all our gains are capped up there at just over 4,000. See where he's pointing right there. $4,180 is the most money we can make in this trade. And where does that money come from? Well, that's the difference between the two strike prices. So we have a 255, 200 spread. That's $55 minus our cost of $13.20. 55 minus $13.20 equals that $41.80. That number right there. So as you kind of simplify this down, that risk graph is at expiration. If we fast forward, we can see where the stock would be and how much profit or loss would be in this trade.
I think we had a really good question here by someone. June Soto says, it's Vincent. He says, hey, how do you respond to these questions when I ask? There's a question box you can type into. Some aren't finding it. Tell you what, Vincent, maybe we'll do a little tutorial on GoToMeeting, because we shouldn't assume everyone knows how to do that. Just, I've been doing it for a lot of years, but, it's new. It's new stuff. So this important. Now, Darja, I'm going to, is it Dara or Darja? It's probably Dara. I'm going to ask you this. Who would like to know what the purple line is for? Say I would. This is so bad of me. I'm going to be really mean here. Who would like to know what the purple line is? Well, if you go to the 4 pillars of investing and you go to pillar number 3, which is called cash flow, you'll learn something called time value and something called intrinsic value. And if you go to that and you learn time value, that'd be a good homework assignment for this week. This week, everyone's going to go to the 4 pillars. Some of you finished it. And your homework is to try to figure out as best you can through the 4 pillars, time value versus that. I love it. Some of you guys, I'm working on it. I'm almost there. Veronica's just starting pillar 2. That's okay. Right? That's right. Katrina has it right. She asked that question. That is correct. So the purple line represents the time value of the option. And so once you start to understand time value, you'll notice, when does this expire? June 20th. So if I go to fast forward
June
my
20th
date,
would be the weekend, right? Yeah. So June 19th, if we look at it, June 19th is the last trading day, that third Friday.
So if I go here, let me erase my ink. If I go here and I advance the date to June 20th, watch what happens to the purple line. Oh, it's gone. There's no time left. So understand that if I want to sell an option that I bought before expiration, there still might be some time value left in that. So once you understand the difference between time value and intrinsic value, you'll catch that a lot better. That'd be a little heavy to do right now, I think, in my opinion, to start learning about time value and intrinsic value. But as you look at an in-the-money option, let's find one that's in the money here. As you look at the in-money option, you're going to see there's an intrinsic value to it and an intrinsic value. And when you add those two together, you get an option price. Well, the intrinsic is without time. The extrinsic is that milk we talked about, that time value of the milk. So these are out of the money options, and they're going to have a lot of intrinsic time value and less intrinsic value. So you'll learn that in the 4 pillars. We cover it. Hey, there's a lot to learn, huh? Mary says, Andy, where did you learn and how many years you guys been doing this? How many years you been doing this, Corey?
About 20 years. Yep.
Yeah, I've been studying a little over 20 years. Where did I learn? I took a class they're not even around anymore. The company that used to offer them, they're not around anymore, but I took a class just like you are. Learned it the same way you are, Mary. Exactly the same way. My first instructor was Rhett. His name was Rhett. But guess what? He wasn't as good as Corey is. So that's really, really cool. Fantastic. That's right, Trace. We're capping our gains at 200. Why? Because we've made a promise to buy stuff at 200. And if you're buying things at 200 and it goes down below that, you're not going to be making money. Okay, there's a lot of stuff. Now, here's the good news, Mary McEwen. I've been doing this for 20 years, but it didn't take me 20 years to learn it, right? It's kind of like I've been riding a bike since I was like 7 years old. It took me a couple of weeks to learn to ride the bike, right? So that's cool. Ronald Miner says, can I see you? I can't see you, but I can see your question right in here. So you're going to be able to do it. Here's the important thing. Have confidence that you can learn little jargons and little stuff. Again, this is a quick start lab. And so, we're having to catch up. We're having to go quick. But if you stick in this, it's like anything else you've done. So that's awesome. Thank you, Theo. Thank you for the nice compliments. We try to do this. CK says, this is fascinating. I'm so excited and I feel comfortable. Good. Awesome, Mary. You're awesome.
This learning really should be. I was just going to say, this learning really should be a little bit like exercise. When you haven't done it and you do it for the first time, it's sore. Your muscles are sore, and you walk up the stairs and your body hurts. That's probably what your brain feels like a little bit as you're first learning this. But when you start to put it into practice, all of a sudden that soreness goes away and you start to feel, better about it, and you start to see that improvement. And that's how it is. I mean, there's a learning curve here, but that first little bit of learning this is the difficult part. So you got to push through that, knock down that barrier, and keep after it.
And the big key is to get through your 4 pillars, right? If you get through 100%. The 4 pillars, that's a huge thing. Okay, let me give you a little tour again, finish up with the Cash Flow Academy here. And let's get rid of some of this stuff here. So, and then we'll close it out. You guys are such a great job. You can always go to, so important stuff about this. As you're studying this, okay, let me log in again. As you're studying this, you can always go to support, okay? And at support, you can always, get support. If you want to submit a request, this goes to Corey. You say, hey, here's my email address. Here's the subject. Here's what I want to know. So you can submit a request. That's on support tab. So you go to where? Support, click, submit a request. Or there's a bunch of frequently asked questions here too that people ask, recent questions people have been asking that we can help you with, okay? As you get in here, these are the Quick Start Labs. So you go in here to Quick Start Labs, and you go to Quick Start Labs. Session 1 is the first one we did. Watch this. And session 1, we have the 2020 Quick Start Lab that we just did, right? And if you go to session 2, Quick Start Lab session 2, right? Oh, we got the 2020 Quick Start Lab we just did. And if you go to session 3, oh, there's no 2020 Quick Start. Oh, that's because we're recording it right now. So I will finish this recording, we'll upload it, and you'll be able to review that session 3, because right now we've got 2019 in here. We're recording the 2020 one right now as we speak. So this is where you go. And what's fun is, look at this. You can not only do the one we did, 2020, you can do this 2019, 2018, 2017, 2016, 2015. There is no shortage of education here for you guys. You can spend as much as you want there. Now, Philip says, how can I get a coach? So the way we do this is we do it in small groups. We get a group of 3 or 4 traders together. This is obviously labor intensive. So Corey has a team of coaches. Okay, Philip. And right now we have a waiting list to buy coaching. So if you'd like to know about pricing on personal coaches and spend your first 6 weeks one-on-one with either Corey or someone on his team, what do? You go to support and you submit a request. You say, here's my email address, subject would be coaching, and then you say, hey, put me at the front of the list. And we'll say, oh, we have to be fair, we can't. So there is a bit of a long list on that, but the way we do this actually is I'll just be transparent in how we do it. We offer this to about 30 people at a time. And so there's a bit of a list. And we just tell you, say, hey, if you're ready, great. If not, we go to the next 30 people in line. And we just do it in chunks of 30 all the way down because we only have so many coaches. So that's awesome stuff. So great job, you guys. Who had fun? You're welcome, Faisal Hadi. Great. Me, always having fun. Great stuff. Gideon says, awesome. Me too. I absolutely, I get all emotional all the time. I got to knock this stuff off. I have to say something to you guys. Everyone, there's three. I'll finish the quick start lab with this little philosophical stuff here. So I'll just finish this with these sediments. In life, you can have different experiences. Oh, maybe I can't share this because I've dropped my pen. That's hilarious. It's clear down here on the ground. Let's see if I can lean over my great big belly and get it. I read this in a book called, I think called The Happiness Advantage. You can have a job, you can have a career. I don't know how to spell career, something like that. You can have a calling. And, the financial rewards, I think, are there for all of us. If you start a business, those rewards are available. Sometimes you go out of business a couple times before you get them. There's financial rewards in real estate and stock. Sometimes you lose a little money on the way getting them. A job is where you do something you don't want to do in a place you don't want to be with people you don't want to be around to get money. And I'm going to say it again. A job is generally in a place you don't want to be at a time you don't want to be there with people you don't want to be there doing something you don't want to do in exchange for a paycheck. That's rough. Career is more about your self-ID. Career is more about, hey, I'm a doctor, I'm a lawyer, I'm a plumber, and I'm climbing the corporate ladder and being successful. But a calling is, when you get lucky enough to find what you were put on the earth to do. And I don't know that I'm the best teacher in the world, right? I don't know if I'm the best teacher in the world, but this is what I feel my calling is. And while I've made some money in business and made $1 or $2 in real estate, and every once in a while we get a stock trade right, without getting too emotional about it, the opportunity to be here with you guys and to watch you struggle through it and watch you fight and watch you guys. Oh, Mary says sales negotiation. I'm pretty good at sales too, Mary. I'll admit that. But to be a teacher and to try to break this stuff down and help people fight through, what's the difference between long and short, and am I ever really going to get this? And, a person who gives up 2-3 weeks in, I have nothing I can do for that. But if you stick with me, thanks, Greg. If you stick with me and Corey and Noah, you're going to learn this, okay? You are going to learn this. And it's going to be a matter of discipline then. Right, discipline. So I feel very blessed to receive your emails. It makes, hey, I'm like anyone else. When someone says, hey, I really appreciate you as a teacher. Well, this is what I was put on the earth to do, is teach people this stuff. I can't beat Warren. But if Warren Buffett opens up, a course, take his course. But until he does, Corey and I, we love teaching, and we love you guys and our mentors. So that's kind of a nice thought to end on, I guess. I love you guys. Hey, stay safe. Okay, stay safe. Thank you. I'm just, you guys, there's no regrets on signing up for this course, he says. Look at this. It's 7:30 a.m. on Australia, but I'm here. Thank you. Thanks, Kevin. Appreciate you. Lots of, training Jedi. It's just so many comments. I can't even reply back to them all. Thank you, guys. So we will see you guys. When's the next Quick Start Lab, Corey? Thursday?
It is, I believe,
Wednesday?
Thursday. Let me double check here. Thursday night.
Yep, it's Thursday
looks like
evening.
It's Thursday night.
Unless you're on Australia.
PM Eastern time, it looks like. Yeah.
Unless you're in Australia, it might be different. But you guys are just fantastic. Stick with this, okay? We never quit. Stick with this. Just because you don't understand something the first time today, just understand it's not going to take you 20 years. You're going to get there, and we're going to learn these trades little by little. Remember, it's a Quick Start Lab. keep on your 4 pillars, keep studying that, and we'll see you guys next time. And thank you so much, Corey. You're fantastic. Thank you.
Thanks, Andy. We love you. We love all of you. Thanks, everyone. We'll see you on Thursday.
Awesome.